This is important because balance of payment statistics provide an indication of pressure on a currency's foreign exchange rate. Okay. Last week, we talked about the determination of foreign exchange rate. Foreign exchange rate is nothing but the price of foreign currency in terms of domestic currency. You can express it in the opposite way, like price of domestic currency in terms of foreign currency, but and they're all the same. It's just the exchange rate between two currencies. Okay. And the balance of payment statistics, if we look at those statistics carefully, we can have an idea about which way the foreign currency, the foreign exchange rate of a country, of a currency, is going to move in the near future. Okay, depending on whether there is a free floating exchange rate or fixed exchange rate or managed float rate, you can develop an idea about exchange rate between two currencies if you closely follow the balance of payment statistics of those two countries. So, for example, you want to forecast the price of US dollar in Australian dollar. If you closely look at the balance of payment statistics of Australia and the USA, you will have a good idea about how the exchange rate is going to move in the near future, at least in the short term. Okay, it provides a signal on the imposition or removal of controls in various sorts of payments. Okay, so they provide an indication on trade control, the imposition of tariffs and quotas. Okay, because if a government imposes trade controls, the balance of payment statistics are affected. We'll go through them closely and more thoroughly. So yeah, and as I said, it helps you understand, forecast a country's market potential, at least in the short run. So if you know that if you know that the Australian dollar is going to lose value in the short term, that provides an indication that Australia is going to have a competitive advantage in the export market, because Australian export in the rest of the world is going to be cheaper in the near future. So that helps you to judge, to analyze the market potential of certain Australian products in the world market. So if for example, if you know that Australian dollar is going to cheaper in terms of Chinese yuan or Chinese renminbi, then you can expect that there will be increased demand for Chinese wine, Australian wine in China. Okay, provided there is no political tension between the two countries, which we have seen in the recent past. Okay, so without any further delay, let's talk about the different parts of the balance of payment, balance of payments. There are three major accounts. Okay, three major parts in the balance of payments accounts. First one is current account, which records all exports and imports of goods and services. Okay. The second one is the capital account, which records transfer of financial assets and the acquisition and disposal of non-financial assets. Okay. Now, this one, capital account, it has recently been introduced by the International Monetary Fund, and throughout this unit, we'll merge it with the financial account. So will not talk about capital accounts separately. Rather than that, we'll talk about capital and financial account. Okay. So next one is financial account, which records public and private investment and lending activities. Okay. Cross-border activities. Again, all public and private investment and lending activities. And as I said, will not consider capital account, the second component, separately. So whenever we'll talk about capital and financial account balances or transactions, we'll refer to capital inflow and capital outflow, which incorporates both investment and lending activities, plus all sort of acquisition and disposal of financial and non-financial assets. Okay. Now we'll talk about each of the two components in greater detail. But before going there, we must talk about some accounting or record keeping perspective that are important. Okay, so the BOP statement is based on double entry bookkeeping. What does it mean? It means every economic transaction, every cross-border transaction is recorded as a credit and an equal offsetting debit entry. So it is every transaction is recorded in two places, as credit and as debit, as a debit. Okay. So the accounting, according to the accounting convention, credit refers to a decrease in assets or increase in liabilities. For example, the export of goods or services that records foreign exchange earned is an inflow of foreign exchange to the country. Okay. And debit refers to an increase in assets or a decrease in liabilities. So for example, payments for imports or purchases of services, their outflow of foreign exchange, they are considered debit. Okay. So as I said, every cross-border transaction is entered twice in the BOP statement. Okay, so let's consider an example. Okay, let's consider an example. Suppose an Australian company exports machine tools to Malaysia at a price of 300,000 Malaysian ringgits. Now, assume that the current exchange rate is that one Australian dollar equals 3 Malaysian ringgit. Okay, so the Australian company which is exporting a machine tool price is 300,000 Malaysian ringgit, which is actually worth 100,000 Australian dollars. Now, the same transaction is first recorded as a credit. Why? Because it refers to a reduction of Australian goods. So that machine tool was produced in Australia. So when it goes to Malaysia, actually there is a reduction in Australian goods. So that 100,000 Australian dollar, it is actually first recorded as credit, which is a reduction in assets. Now, on the other hand, the same transaction is followed by an inflow of foreign assets, an inflow of foreign currency, which is worth 100,000 Australian dollar. So the machine tool is going to Malaysia, it's credit, and 300,000 Malaysian ringgit is coming to Australia, which is recorded as a debit. Okay. Now, this is a very simple example of double entry bookkeeping. Now, because of double entry bookkeeping, when we supplement with errors and emissions correctly, the balance of payment is actually always in balance. Okay. Uh, yeah, that's what we say here. A balance of payment is always in balance, just because of the double entry bookkeeping. Okay. Let us go back to this simple example. There is no scope of errors or emissions, but when you record billions of dollars of transaction every year, it's possible that there are errors and omissions. Okay. So if you consider those errors and omissions, in the ideal world, if you don't ignore, if you consider all the errors or emissions, the balance of payment will always be in balance. But in practice, it doesn't happen. So in practice, we say and we check whether the balance of payment is actually nearly in balance, okay, whether it is close to zero or not. That is something we look for in practice.